Now, Apple has had several reinventions of itself, but you can see here the section we're going to look at is the initial legs up that it had in 2003, 4, 5, and 6. And you can see it was rather evident at the time. Steve Jobs was on multiple magazine covers. This is February 2004. This is also 2004. And the Apple iPod was really taking the world by storm. I mean, I had one. Everyone I know had one. If you think of what it was, if you think of what it was like before to listen to music with a CD player, it was quite a terrible experience. You couldn't go for a jog or the CD would skip. So to have all of your songs on one small little mini computer was really a breakthrough. And they did an absolutely incredible job of executing. So the fundamentals really were in place. Earnings and sales were booming. It was a new product that was changing the way people live and play. It was really a major step forward in how the world listened to music. I mean, they also came in with their iTunes, and they were starting to monetize the music itself. Completely game changer in terms of the music industry. So let's see, once you had that backdrop, you knew they were going to be major winners, or at least you had the idea that they'd be major winners, and you saw it come through in the fundamentals. How did that look on the charts? Where could we have bought the stock, concentrated, but remained risk conscious and safe with our capital? So this is that original cup with handle we saw in Apple that we covered earlier in the course. I really want to go into detail here about how we would have taken that and gone through the entire process here. And you can see, similar to DEC, in the prior example, we had this great prior uptrend where there was a lot of buying going on in this stock. And this cup with handle here is absolutely perfect. Although you weren't showing a lot of relative strength at the time as this cup was forming, that did come in later in several examples. You'll see here that there was a lot of tightness of volatility. Look at these 3 weeks in a row that closed in the same place. As the handle formed, you had multiple weeks that closed right in the same place, that tightness that William O'Neill talks about. It was really, really evident here as the stock was progressing. It was only 24% deep, so it was really within the norms. The handle was 11% deep, which was also perfect. And the base length was 19 weeks, which was more than the 7-week minimum that you require for the stock price. You'll also notice there weren't any significant selling in the base. You had 1 week of slightly above average volume, which, I mean, there is some selling going to take place in the basing structure. But what I really like here is as the right side started to form, you did have that increase of volume come in on the weekly chart. Now, if you didn't use your tactical buy point and you just rushed in to buy at new highs like so many people do, that inevitable reversal came in where the volume, kicked in and the stock sold off and formed its handle. That's why you really want to avoid just chasing stocks breaking to new highs and really wait for all of our proper entries. It's just so important. So let's flip over to the daily chart now and look at all of our tactical buys and our positioning. As you can see, the weekly chart really showed all the footprints of institutions. I forgot to mention here on the left side, you also had a bunch of tight trading here as the base was beginning to form. So there was really a lot of tight trading, and all those signs were really evident that there was some kind of buying going on in this stock. So let's see how we could have timed that on the daily chart. So when there's that great backdrop of this great product, you really want to start looking for a place where you can enter this stock safely, even if it's not leading the market at that moment. And the market was really in a very strong uptrend. This is after the 2002 tech crash. You can see this is 2003 into 2004, consistently net new highs going on in the marketplace. And this stock was correcting, but you had this great three-touch trend line that took place in this basing structure. And I just love to see a trend line that's just so great like that. And right at the end here, you actually had a shakeout of the prior low here, right as it tested the 200-day moving average. However, again, you don't want to use these 3 EMA shakeouts as entries if the stock is not showing relative strength against the market, which it wasn't at the time. So you'd want to see that break of resistance here of that three-touch trend line take place, and that could have been your first entry into the stock. Now, the same assumptions are going to hold here as they did for Decker's Outdoors. A full position is $50,000 or 25% of the account equity. Each stock purchase will be 1/3 of a position or $16,000, $1,700, and the maximum stop loss will be $1,500, 3% of a full position, or 0.6% of account equity. So let's see how much money we can make by only risking 0.6% of account equity. So that break here of the three-touch trend line would have allowed you to buy 450 shares at $37.40. Your $1,500 max loss would be $3.33 or $34.10 a share as your exit point, which is shown right here with your initial stop. Soon after, you had a 50-day moving average breakout with volume. So you can see we really broke through the 50-day average and the volume swelled above average. So we could have bought another 420 shares at $39.59. This, again, is 5.8% higher than the prior buy. You want to wait at least at 5% between buys so that your cushion will be large enough that you can withstand normal pullbacks in the stock price. We now have a total of 870 shares with an average cost of $38.46. Our $1,500 max loss will allow us a $1.72 loss per share, or a $36.74 exit point, which is indicated with the red horizontal line. Fortunately, we kept blasting higher and we never actually challenged that exit point. However, if we were patient and we had that pullback as this handle formed, we were going to be looking for some additional buy points for this stock. And it was great if you would wait for that cup with handle breakout. You could have purchased another 375 shares at $44.45. So you now have a total of 1,245 shares with an average cost of $40.26. It's now a full position, 25% of account equity. We have a 10% cushion. And so we can even bring our stop loss up to $0. And so $40.26 is going to be our exit point. So already at this point here, we have a quarter of our account equity in the stock, yet we no longer have any of our original capital at risk. Look how powerful position building becomes when you use all these tactical buy points with those shaper patterns. So again, out of this cup with handle base, similar to Decker's, you have this huge volume surge, which is really what you want to see. You want to see volume come in on those shaper breakouts. It's really critical because it really confirms that that prior supply is now being broken. So we break higher, we run up, we get those normal pullbacks, and very shortly we get our 15% in 4 weeks hold rule that triggers. So this is showing relative strength in the process. That's why we're using that 15% hold rule rather than the 20% in 3 weeks. So we must hold the stock for 8 weeks. And you can really see that relative strength here. The market really moved lower over this period of time, whereas Apple on this breakout was surging higher and really was a rather weak market that was preventing the stock from just running away. Again, it's great to keep your net new highs in view because although the market was pulling back, the internals of the market stayed pretty strong the entire time. You're really locked in this consistently net new high period here. So there's a pretty good backdrop of a strong market to keep you long the stock and not have to worry too much about a weak market, despite the fact that the actual index was moving lower at this time. So after this initial thrust, we have our first touch of the 10-week on this pullback here, which again, it's a proper use of the 10-week line because we are out of the basing structure completely, so we can use this as our first touch purchase here. However, I do want to point out if you missed that entry there as the first touch of the 10-week, if you don't like to buy a stock coming down, you could have waited for the 50-day moving average bad break failure expectation breaker. You can see here we broke the 50-day on some decent volume. It was a slightly above average. And when the stock finally took out the high of that bar, you had that expectation breaker. Anyone who was looking at the daily chart alone and saw this bad break of the 50-day average would think like, oh no, this stock is finished and it's going lower. However, we knew with our weekly shaper patterns and the 8-week hold rule that clicked in, this was actually a really strong stock. So when this break of the 50 failed to have any follow through, you wanted to purchase more stock as you broke above the high of that bar. And that's where this expectation breaker comes in, and it was a great additional buy point. So again, in the similar space, you could have bought on the 10-week or you could have used the expectation breaker. In this case here, we had the 350 shares purchased at $48.20. We now have a total of 1,595 shares with an average cost of $42. This now, at this point, is a pyramided position. We have 33% of our account equity rather than the 25% full position. But we're going to bring our stop up to a break even of $42 a share. So you're rather concentrated and you really have no more risk of losing money on this trade. And that stop loss is indicated here with the horizontal bar at the lower end of the chart. Again, it's amazing how all this position building allows for cushion and it allows for a concentrated position with your risk rather controlled. And also at the end of the 8 weeks, this is really the first pullback to our 10-week moving average. You see a lot of relative strength in the stock. Whereas the market was lower over this time, this stock was higher over this time. So you really want to make the decision at the end of that 8-week hold period that you're only going to use shaper sells to exit this stock. And this small closable, the 50-day on average volume, was not a shaper sell signal. So you have a possible major leader developing and we're only going to use shaper sells. And thanks to our position building, we have a rather concentrated position soon after an initial first stage base breakout. So buckle up, we may be in for one heck of a ride. And from this 50-day moving average pullback, we start to really accelerate into new highs here. And this is really starting to impact our account because we're rather strongly positioned. Again, you see that relative strength clicking in. The market here made lower lows than this period here, and the stock is still making higher lows. So you really know you may have a major winner on your hands. As well, the stock was able to get to new highs much sooner than the market did. So Apple's really exhibiting those footprints of institutional accumulation. And really, as soon as the market got back into gear and started to make consecutive net new highs again to bring up this green condition, that's when the stock really started to run away. So the fact that that market pressure came off really allowed the stock to soar. And I'm sure once you dive into tactical buy points, you'll see a lot of other buy points will come up. But for simplicity's sake, I only showed some of the buy points that occurred because, to be honest, you don't want to have 3/4 of your account in a stock without adequate cushion. You really want that to build over time. So we're not going to take every single buy signal that comes up, even if the stock is working for us. Let's move on to the next stock chart here, where this stock continues. And you'll see here I indicated where the last chart left off. Our current position stats are here on the upper left side, so you can follow along. And actually, the $42 stop is not even on the chart, so that's great to see how much of a cushion we've developed here along the way. Our break even is outside the view of this chart. And so we start to pull back here into the 50-day moving average again. We have a buyable gap up here after this pullback to this 50-day. You may have been tempted to buy this stock, but you're in poor market conditions at this point. The market really started to get hit both in the actual price of the index falling and as well internally with net new lows, having consecutive lows here for multiple days showing a negative backdrop. So you want to pull off. You already have a rather concentrated position. You have a third of your account. You have a nice cushion. You don't want to mess that up by adding too much too quickly. But over time, you can see this stock is showing immense relative strength. As the market keeps falling lower and lower here, this stock actually makes a higher low. And you can really see these are the footprints of institutions not allowing the stock to drop. They're using the market weakness to pick up more shares. And again, I'd argue that's a way of them paying up for the stock, because normally the stock would mirror the market and it would come down with the market. So just the fact that the stock is not falling, they're paying up because normally the stock would be lower. And despite the volatility of the market coming down, this stock starts to get really tight as this larger triangle coil shaper pattern shows up here, which now is a stage 2 base. And within this overall coil pattern, you actually have a mini coil that shows up. So again, multiple buy points showing up here. You have a 3-touch trend line, you have a weekly shaper coil forming, and also a mini coil. So as this breaks through, you can start to add to the stock. Again, at least here, you're starting to exit a period of extreme market weakness. You're starting to come back into a period of, let's say, market neutrality. And so you can maybe start to add to the stock since it's showing such strong relative strength. So it's our fifth buy. We're going to buy 295 shares at $57 a share. We have a total of 1,890 shares with an average cost of $44.34. We're up to 42% of account equity. And again, we're going to have a break-even stop at worst here at $44.34 a share, which is a rather large amount of cushion. We're looking only for shaper sells at this point. As we advance, we get another mini coil that takes shape. So you could have added another 265 shares at $62.90. We now have half of our account equity in this position with an average cost of $46.62. And some reasons to add is one, this is really a major winner. We're also back to new highs here of the base way before the market is, and this showed relative strength throughout the entire basing structure. That relative strength is so key. Every market winner typically has that relative strength. So if it has every other characteristic and you're seeing that relative strength show up, you really want to keep your eyes peeled for adding to your position. I'm always cautious to add when a stock's showing relative weakness, but if I see that relative strength and I see buys come in, I'm going to want to run to that stock. And you can see also that second mini coil came in where the market really started to show that it's back in a bull trend. So you really want to start adding to positions where you could. And what better place to add than a stock that already has a nice cushion developed for you and is showing relative strength. So we had our sixth purchase here, and we now have half of our account equity in the stock. And as that market weakness starts to lift off, the stock starts to just really run away here and become a major, major winner. I didn't highlight any other purchases on the stock chart. I'll leave that to you to dive in and look for additional buy points if you see any. But already you have half of your account in this stock. Your stop is way lower, significantly lower below the 50 and the 200. So any shaper sell will clearly show up before you get to a break-even exit on this position. But this stock really starts to run away. And you really would have only been positioned this significantly if you use both position building and your larger perspective of that weekly chart and the relative strength. It's really how these all come together that make it such a powerful system. And I don't see how you could ever have these kind of positions with this kind of controlled risk any other way. I mean, this is hands down a better approach to have a concentrated position with limited risk. So as the stock really runs away here, let's move on to the next chart where this continues so we can see how we handle this position. So the last chart left off here, again, we kept the trade stats here on the upper left side so you can follow along. We have 50% of our account equity with an average cost of 46.62, which is also our worst case break even at this point. But this is a significant winner here. I mean, we're at $100. We're already at a double with 50% of our account equity. So it's something you really want to watch only for shaper sells and see if it develops some kind of other base. And soon after, we did develop a flat base here. If you flip over to that weekly chart, which I really recommend you print out and keep separate so you can compare the weekly with this daily chart, we start to form this flat base, which had all of the perfect characteristics. And as this flat base developed, you also had additional tacticals that showed up. You had a 3-touch trend line, and you had another great mini coil step in. So you could have purchased 140 shares at $117 a share. You now have a total of 2,295 shares with an average cost of $50.91, and this represents 58.4% of your account equity. So again, you do want to always be careful when you're adding at higher prices. You want to keep your dollar amount invested consistent throughout the entire trend so that you don't raise that cost too quickly and then risk being stopped out. So you have this additional buy here on this flat base. The stock starts to move up, and we even end up gapping up out of this flat base. And we still really start to run here. And now this flat base was really a third stage basing structure. We had that initial cup with handle, we had the large coil triangle, and this flat base is your third base. So once you get to a third base structure, you can start looking for shaper cells only 1 month out of that base. So this is where all of your tools come together, everything that you've learned. And if you didn't understand basing structure and base counts, you wouldn't be aware that, hey, we're late in this trend. So the life cycle of a stock is really going to come in here to help us to exit the stock right into strength. Whereas earlier on in the stock's advance, we weren't selling into strength because it was too close to our base 1 and base 2 structures. So as we run away out of this third stage basing structures, just about the time you can't believe all the money that you're making and you're so happy, you have to step back and start to look for those shaper cells as you're a month out of your third stage base. And you see rather quickly, you start to get all of these exhaustion gaps higher. I mean, you're rather extended from this basing structure and you get a gap, gap, gap. And this is really where you really want to start selling. And you'll also see that climax volume coming in, a real surge of volume. And so really here you could have sold on this climax top. You would have sold your 2,295 shares at $157.87 for a profit of $245,500. That's a 500% return on a full position and 122% total account return. This one position more than doubled your entire account. And remember, your maximum risk from the start was $1,500. So this whole trade was 163 times your initial risk. You could be wrong 163 times in a row after a trade like this, and you're still breaking even on your account. That's absolutely incredible. Now, if you did miss this climax top, that's why you want to have multiple rules, multiple ways to exit a position. Sometimes you miss it. Sometimes you're not sure. You're holding on. You think you have a winner, or your emotions get the best of you and you're not ready to sell, which is a mistake and something you have to get a hold of, but it does happen. That's why the system needs to be adaptable enough that you have backup. So if you did miss that climax top, well, eventually you had that 10-week moving average bad break here, and you would have sold at $126.25 a share. Not as good as the 500% return on a full position, but you still manage a 340% return on a full position. And a number of factors started to come in here. You really had a big volume breakdown here. You'll see the market started weakening. And let's flip over to that weekly chart. You'll see here on the weekly, it really became evident. You had that 10-week bad break here, and you really needed to exit that position. Also, the climax top, we didn't take a look at that before, but you had a number of weeks in a row up, and you had some real extension from your 10-week moving average. And this is one of the highest extensions from the 10-week moving average, except this area here. So if you did miss that as a climax top, despite all those exhaustion gaps, more than a month out of that third stage base, you could have sold on that 10-week bad break here that occurred on the weekly chart. But the story's not over. I mean, Apple was a major winner, and just because you exit a position doesn't mean you have to ignore it. I mean, a stock can set up again. So what looked like a basing structure here eventually broke to the downside, but the fact that you broke this basing structure reset your base count. So you're starting over back at a stage 1 base again. And that's a really important concept to understand. And so you can see here in this basing structure, you had 3 tight weeks. Also, if we go back to that weekly, that flat base, I don't want to jump back here, but we didn't take a look at the weekly before just to keep ourselves focus on that daily. But in that flat base, you had a number of tight weeks here as well. So it's really those footprints of tight weeks are really so important. You also had 3 tight weeks within the coil pattern earlier that we bought out of on the daily chart. But despite this big breakdown, the stock then went tight for 3 weeks, and that volatility really contracted. You had a break of a prior low here in the base, and there was no further follow through. It immediately started to move higher. So you can see sellers were not able to get further control of the stock despite a rather weak market environment. As well, relative strength is still present in this stock. You can see the market made significant lower lows here, but this stock was really higher than the prior point when the stock had bottomed last time. So there was still a good amount of buying strength in this stock. And as this cup with handle started to form, you had more buy points again that came through on the stock, which we eventually sold. But let's move back to our daily charts to see how we would have timed this again tactically. I just want to note here that we had a cup depth of 27%, which was still very controlled, which is very normal. A handle depth of 5%, and the base length was 24 weeks. So all of the criteria on the shaper was in place, and knowing the story that the iPod was changing the world, this should have still been on your radar. So you want to flip over to your daily charts. You locked in all of your prior profits, and now we're going to see how we can get those profits to work for us again as this new shaper develops. So here you can see this is our weekly cup that was forming that we just looked at. And this is the breakdown here that happened last time. Our account size is now $445,000 thanks to our sell on the climax top. And so we're going to increase our full position from $50,000 to $108,000. Our individual buys will increase from $16,000 to $36,000, and our max loss will move up accordingly from $1,500 to $3,200. This is really where that compounding effect kicks in. And this is why it's so important that you have a system that you can grow with. For years when I was trading really short-term and day trading, it's hard to keep increasing your position size because market liquidity really becomes an issue when you're trading very short-term time frames. The fact that we're position building and we're using weekly and daily charts, there's really no limit to what an individual investor can pretty much do in the marketplace. So you can really start to increase your size now that you locked in those great prior gains. And so one thing I want to point out here is not everything's going to work. You would have bought maybe this 50-day moving average volume break. You see some good volume came in, and the market did start to turn to more favorable conditions. However, this was stopped out eventually, and you were kicked out of this stock. You took a small loss. You lost $3,200. You just made a huge amount of money from your prior uptrend, and so losses are part of the game. Not everything is going to be so clear and have these major gains right away, as I'm sure you're more than well aware of. But now something starts to occur in the stock, and despite the market being rather favorable and the stock index moving higher, Apple starts to run into a headwind, and you can see you actually have poor relative strength here. So I wouldn't be really looking for additional buy points here because although this was a great winner in the past, you have this poor relative strength, and your last entry really failed despite a strong market. Now the best way to enter a stock if there's poor relative strength is typically an earnings gap up. That buyable gap up will typically reignite momentum, and it can break poor relative strength. Without that momentum gap up to reignite relative strength, you may be stuck with a loser, an old leader. And that's a real big possibility. I mean, Apple went on a major run that we cashed in on, and often stocks top, and that's the end of that story, and that life cycle is over. Not everything turns into a continued winner. That's actually a rather rare condition to see. So if you're seeing poor relative strength, if the backdrop of the stock is still great and you know the story and you think it's going to be a big winner, the best way to enter a poor relative strength stock is to wait for some kind of a buyable gap up that will reignite momentum. That's what happened here. We had a buyable gap up on the right side of this base that was coiling, which also coincided with this great 3-touch trend line break. And we would have bought 250 shares at $145.70, which is 8% of account equity, a third of a full position. And we have a $3,250 max loss, or $13 a share. That stop exit point ends up being $132.70, which is indicated with this red horizontal line. So we continue our move higher, we form our handle, and we break out of this handle. Again, you can see this handle broke with big increasing volume, which is exactly what you need to see as that handle is breaking. So we purchased another 230 shares at $158.25. We now have a total of 480 shares with an average cost of $151.71 a share, which is 2/3 of a position. We keep our same $3,250 max loss, and that puts our stop at $145 a share. Again, thanks to our position building, we have quite a bit of space on that breakout. If there would have been some volatility here or some turbulence at that turbulence zone of the prior high, you had quite a bit of space here to allow for some downside movement. But luckily, the stock didn't cause any kind of a problem for us, most likely because the momentum and the relative strength was reignited thanks to the gap up higher. And here you actually start to see now positive relative strength come back into the stock. You can see here the market starts to head lower, but this stock is now making a higher low. So you really want to start to dial in and look for new ways to add to the stock, because you have a potential big winner. You have great cushion, you're breaking out of a cup with handle with great volume, and that relative strength is starting to show up on your daily chart. As well, you're really locked into a favorable market here, and you have consistently net new highs, so you really want to be in buy mode. And so buy 3 clicks in here, you have a nice kicker where we gap higher after a red body candle on the prior bar in the middle of a consolidation. So it's just a great place to look for a good entry here. And we purchased another 215 shares at $167. We now have a full position, which is 705 shares at $154.25. That's 25% of account equity, and we still have that same $3,250 max loss, or $4.60 a share, placing our exit at $149.62 a share. Again, you have quite a bit of playroom here in case some kind of market volatility comes in. But what's also really nice to see is I love to see my stop below that 50 and 10-week moving average, because I know those are usually going to be good support areas if the institutions are purchasing the stock. So that gives us quite a bit of support room here prior to having to exit the position. So let's move on to the next chart to see how the stock chart continues. So we left off here on our last chart. This is our current stop. This is all of our trade stats with our current average cost and positioning. And you can see this is really the first touch of the 10-week moving average since we broke out of that prior basing structure. And although the market here is actually turning negative in terms of condition, in terms of net new lows, the stock is showing an immense amount of relative strength. I mean, look at this market making consistent lower lows and lower highs, and this stock is just powering higher. You can tell this little down move in the stock is just as a result of the market falling out of bed. So institutions are really gobbling up shares here. And this touch of the 10-week line, given our cushion, you could have got a little more aggressive and added to the stock. And so you would have added 200 shares at $178. You have a 10% cushion, so you can raise your stop. You now have a total share. You have a total 905 shares with an average cost of $159.47, which is 32.5% of account equity that you've pyramided past a full position. But thanks to our 10% cushion, you can bring your stop loss to break even, so you're not going to lose any money on the stock, even if the market continues to unravel and the stock starts to break down. But thankfully, most likely due to our strong relative strength and all that institutional accumulation, as soon as the market just starts to level off and turn higher, this stock bolts higher once again. Again, that strong relative strength during a market condition is really the fertile ground that's going to lead to massive upside moves as soon as that market pressure comes off. And this stock just runs away. And we get into a climax top once again. You can see we have our exhaustion gap here. We're up 6 out of 8 days in a row, and all of those great climax signals start to click in. You'll have some climax volume. Let's take a quick look at the weekly chart. You'll see here we're actually hitting our upper channel line, and you start to get that climax volume even on the weekly chart. As well, you're one of the furthest extensions away from the 10-week line for the entire advance. So all of your climax rules are really coming into play here. You're also many months out of your prior basing structure, so the time element is also present for you to sell into the climax top. So we could have sold on this last exhaustion gap up. We would have sold 905 shares at $300 a share, another major winner here. We would have had a $127,000 profit, which is a 117% return on a full position. That moved the entire account by 28.5%. And now your account is $572,000 of value. So your account has moved up 186% thanks to one stock that you started purchasing 2 years ago. And throughout that entire period, you only had $1,500 of exposure when you started with the stock, and later on $3,250 of exposure with our dollar stop. And you were able to move your account from $200,000 to $572,000, or 186% increase in just about 2 years. Now you can see luck had nothing to do with that advance. This was consistent, deliberate buying at proper buy points with controlled risk, using a fundamental basis that was flagged by weekly accumulation on a weekly chart and sold into strength with all of our shaper patterns, as well as holding on with our hold rules. This is really how the entire process came together. As well, most of our buying except for maybe this one area here where we bought thanks to relative strength, took place in the backdrop of a very strong market. So you used all of your tools, your market, your fundamentals, your shapers, your tacticals, your position sizing, your position building, your risk management. It just all came together and delivered an incredible return. And it was done safely. And that's what's so powerful. Anybody can have huge return. You can go in very aggressive, full margin on a stock, and if it works, hey, you're a big winner. But what happens if that position goes wrong? That's the difference between a professional and an amateur. A professional is always looking at that risk. Remember all those quotes by all the previous market wizards? Risk is of the utmost importance in the marketplace. And the ability to have your risk managed and still deliver these kind of incredible returns, to me, that's just mind-boggling. And what's amazing is during this time, the markets were very strong, as we saw with the net new highs. This was only one position that you were running. If you had successfully caught 2 or 3 stocks during that period, your returns would have been even more incredible. So it's absolutely astounding to see how all of this comes together. And I hope this is just a great way for you to understand how to put all of the tools together. So next, we're going to take a look at how you can use multiple purchases throughout different stocks in real time. And rather just dial in on one stock, we're going to look at responding to market action all at once. And we're going to look at a turbulent time. We're going to look at the COVID crash of last year and how I started to really ramp up my exposure through multiple stocks at once using all of these techniques. And that's really what led to my 346% return in the US Investing Championship. Let's take a look.